Hi, and welcome to the first quarter forecast webinar for 2015, hosted by Yerba Buena Financial Partners. My name is Sally Sauvignon, and I'm the Director of Client Services and Marketing for Yerba Buena Financial Partners, or YBFP. Joining us today is Marilyn Suey, Associate Advisor of YBFP, and Michele Hassid, CPA of Eckhoff and Company. Hosting our webinar is Bruce Frankel and Andy Zittell. A couple of housekeeping items. Should you require assistance to resolve technical issues, please call Katya at 415-334-8000. We will be recording this presentation and posting it to our website for you to access following our time together under News and Resources Events. In addition, your phone lines will be muted. During the webinar, we will be covering where we've been in 2014, where we are today, where we might be going this year, as well as some important YBFP announcements. And you'll be hearing from our guest speaker, Michele Hassid, member of our YBFP outside team of experts, who will be presenting on the top 4 tax developments of 2014 and the impacts to 2015. Out of respect of everyone's time, we plan to spend the next hour with you and don't want to go past 1 p.m. Should you have any questions about the topics we cover today, please email them to info@ybfp.com, and one of our advisors will give you a call to discuss the answer. Before we get started, I'd like to share with you, it is our mission at YBFP to guide and empower our select clientele to make informed decisions regarding their wealth so that they can make an even greater impact on the people and causes they care about deeply. Yerba Buena Financial Partners follows a proprietary process called the Wealth Impact Process. This is a disciplined approach that we have created to provide our clients with personalized service of the highest caliber. Let's get started. At this point, I'd like to introduce Andrew Zittell.
Thank you, Sally. And good afternoon and welcome, everyone. And just a special thank you to Sally for all the hard, extraordinary work she did to put this presentation together for us today. So we really do appreciate it. Good job. There is a lot of information and a lot of slides, and so we're going to go through some of them quickly and some of them slowly. But we have a lot of information and material we want to try to impart to you. As Sally said, yes, we're going to share our thoughts about where we've been, where we are, and where we may be going. There were a lot of surprises in 2014. Some were good, some were not so good. The S&P index finished with some low double-digit returns, but the biggest surprise, perhaps, was that the yield on the 10-year treasuries ended the year lower as opposed to higher as expected. This next slide we have here compares the performance of stocks in developed nations in 2014. It's telling us how the S&P 500, again, had 53 record highs during the year, and in relative performance, significantly outperformed Japan and the Eurozone. Where else have we been? This question, the clean shirt in the laundry. Well, with Japan's amazing recession last year and the Eurozone's growth being basically flat, even with all the other problems we had here in the United States, it seemed to be a place and a destination for money because we did have the cleanest dirty shirt in the hamper of the global recovery of 2014. This next slide takes a little bit of clearing here, so I'm going to start with the colors. Red indicates GDP, gross domestic product growth, green is inflation, and the purple color is unemployment. The vertical axis on the right references GDP, and the vertical axis on the left is unemployment and inflation. As evident here, growth in the United States wasn't exceptional, but it was stronger in the red column on the left than Japan and Europe. In Japan, economic growth was relatively low, and the country moved into recession. In Europe, economic growth, as you can see by the bar on the right, faltered significantly. Unemployment was way high, and the possibility of deflation was a serious concern. This slide shows the S&P relative to other major global indices. As you know, our equity models, our equity strategies, can often and do compromise all of these different indices. According to the London Bullion Market Association, the performance of different various asset classes in the United States are shown here. The S&P index again, having a healthy 11%. The 10-year Treasury, the yield, again a surprise. Gold was flat. The Bloomberg Commodity Index contracted by about 18%. And the Dow Jones Equity All-REIT Total Return Index had a robust 27.89% return for the year.
So just real quick, Ian, I think that's okay. I mean, it's important. Those past two slides is how we develop our models. So all of those different indexes are represented in our equity and bond models.
Right, both the indices and the sectors within.
Right.
This next slide reviews the Federal Reserve's role and its potential impact on monetary policy and the economy. We're all familiar with the conventional policies that the Fed uses. They're raising and lower of interest rates and bank reserve requirements, but it's in the last few years that we've begun to experience some unconventional policies. And it's still taken my head a while to get around the expression of QE2, 3 or 4. I still keep thinking about cruise ships going across the pond. But since 2007, the Fed has pursued both the conventional and the unconventional policies to try and stimulate liquidity and encourage lending and economic growth. What we do know is that these unconventional policies have been taken to a whole new level. Bruce will be discussing later in the presentation and taking a look at the Fed's balance sheet, so we can examine it a little bit closer. We will see in time, though, how this experiment plays out. There are many different opinions about the Fed's role and its impact on the economy. Some experts say that their monetary policy is responsible for the economic growth we've had. I happen to agree with the third bullet on this slide, whereby inexpensive money is going to increase corporate profits with their ability to lower a debt service payment, which is going to then allow them to infuse more money and provide stronger economic growth. There are some others, however, who disagree. This slide basically talks to the fact that McKinsey & Company completely thinks otherwise. Some say, hello, Avon, only time will tell who was right. Welcome to our call. I don't think it really matters who's right. What we do know, though, is like a pendulum, the Fed often overcompensates. It ends up to eventually rest in the middle. But there are repercussions for the actions they take on either side. There we go, a little operator error on the clicker. Again, the biggest surprises that we saw last year were in the bond market. This particular slide just shows the yield on the 10-year Treasury declining from January through the end of the year. I can't tell you how many meetings Bruce and I had last year with portfolio managers, analysts, strategists, pundits, who all told us that interest rates had nowhere to go but up. And that wasn't the case. But just as a reminder for everyone, Economics 101 in terms of bond mechanics, like a teeter-totter, when interest rates go up, the price of the bonds go down. When interest rates go down, the price of the bonds go up.
So real quick, this gets to the point, and we've talked about we need to probably change the name of this from forecast to outlook. We don't believe in forecasting or prognosticating, so I just think we need to, I don't know if anyone keeps a record of all the prognosticators that we talk to and we see on the television all the time. Maybe we should start a log here of all that, but no one expected the yield of the Treasury to go down. Most people predicted that the GDP of the U.S. was going to grow at a much stronger rate last year than it did. All these surprises. There was a whipsaw in GDP from quarter to quarter. So we just need to be careful here, and that's why we manage money the way we do. We can't prognosticate what's going to happen in the future. I don't think any of us really know. We'll talk more about the future later.
I think we stopped prognosticating with Karnak the Magnificent. Okay. This next slide reminds us of the geopolitical risks and the war and pestilence that is just around the globe. Russia annexed the Ukraine's Crimean Peninsula. ISIS reared its ugly head once again, and Ebola seemed to end up in Atlanta, as opposed to just staying on the continent of Africa. These things generally result in a tremendous amount of uncertainty and fear. And again, the relative stability of the U.S. economy, the cleanest dirty shirt in the laundry, made the U.S. markets attractive. In May of 2014, The Economist wrote, "The most notable thing in the financial markets today is the absence of anything notable. Volatility has collapsed to near historic lows." Now, in the first half of the year, that was true, but we saw an increase in volatility in the markets in the second half of last year, which is illustrated in this slide. The VIX, or Volatility Index, which is also has the coined term, the fear gauge, measures investor sentiment against volatility in the S&P 500 looking forward. You can see the increase in the spikes and in the amplitude in the second half of 2014. Notice every uptick in the blue, which here represents the VIX or Volatility Index again, is coupled with downward movement of the green line, which is the S&P 500. It seems that many investors have become complacent, reverting to buy and hold strategies. It seems that short-term memory loss, forgetting the carnage and suffering of just a few years ago, can lull investors into a false sense of confidence. It is our process and our job to help protect you against these types of this type of complacency. This wraps up a little bit of where we've been, and back to Sally. Bruce got something?
Yeah, it says it right here about complacency, and we see it, we're hearing it from some of our clients. They want to take more and more risk, be more and more aggressive. It's our job to be looking out. We here don't forget very easily about the dot-com bubble or the financial bubble of 07, 08. On the VIX, it's a forward-thinking measure. So a lot of times the VIX will go up only for there to be a response by the Federal Reserve of saying we'll provide more liquidity, or the other central banks that are around the world, they're going to do their things, and we'll talk more about it in a minute. But in general, when the VIX starts approaching or going over 20, we start to see all kinds of reaction in the markets. These huge spikes that you're seeing here in 07, 08, and then what we faced in 2011 are relative. It's still, when we start to approach or get over 20, the nerves start to rattle. I think today we're down more around 15, 16 again. So we'll see going forward.
Yeah, and even just to add to that, Bruce, good point, thank you, is that whenever you see the increase in the wavelength, even though it looks kind of steady, that's what's creating those whipsaws in the market.
Right. Yeah. Sally?
Great. Thank you. We'll now share with you a few quick announcements. If you are a client and have not met with Andy or Bruce in the past 12 months, please contact me to set up an annual review. We also offer a second opinion service, which is a complimentary, no obligation service where we can interview and review an individual's financial qualitative and quantitative aspects to provide an analysis of their current financial plan, investments, and opportunities. If you know someone who would be interested in receiving this as a gift from you, please let me know. We are excited to announce that through our other company, Yerba Buena Wealth Advisors, we've been consulting nonprofits in the Bay Area in the development of their planned giving programs. We have events planned for planned giving officers, development directors, and executive directors for the end of this month. We're really excited about our work with nonprofits and their donors as it brings incredible outcomes on charitable causes and the community. To learn more about this, please visit our website or send us an email. Also wanted to let you know that we're on social media and would love to connect with you. So please look for us and connect. Once connected, you'll be able to see the comments made by Bruce and Andy regarding their insights on our weekly market commentary and other current events. We'll now resume the presentation, and I'll turn it over to Bruce.
Thanks, Sally. If you've attended these webinars in the past, you know we, of course, like to tell you what we've been doing here with our models. We use really what is our most popular model called the YBFP Global Growth with Income Sector Model. This combines our ETF sector with our corporate bond sleeve at a maximum 60-40 allocation. You can see here the changes that occurred over 2014. The big impact or noticeable thing here is in the third quarter, when the commodity prices went really to the floor, we exited a lot of those positions, and I'll show you that in a second. The other thing is also the bond market. The bond yields have gone down to very low levels, and just past couple of weeks it started to creep back up. But we've pretty much exited the corporate bond market. We are still, however, in the muni bond market. Now, just to make this more confusing, we've added an overlay here. Compliance, and we don't like it either, but compliance will not permit us to discuss our returns in a public forum in the general aspects of what our models have done. We are, however, allowed to talk about a similar type of fund based on how we manage money. As most of you know, we do not believe in the concept of buy and hold and hope for the best. What you see here is an overlay of the Barclays Global Tactical Moderate Fund. It is managed in a similar way as ours is, using multi-managers, both on the bond and the equity side of things. So you can see here that at the beginning of the year, it took a dip and started to creep back up, and then ended the year at just about a 3% growth level. Now this takes in, now a lot of people react and say, well, but the S&P 500 returned 11–12%, so what's going on here? It's important to remember that the S&P 500 is only US large cap stocks. It doesn't compose all the other asset classes, nor does it cover all the international, and it is purely equity. When you combine that with the other asset classes in the bond market, and you incorporate a protective tactical management, this is what you get. This is basically on average of what we're finding with the other types of funds out there that manage money in a similar way. They are much higher in cost than what we do, but we wanted to show you a similar process and what their results were. So there you are. We look forward to your review so we can talk about what happened for you. On this side of things, this slide, I should say, shows you where we were as of, again, when we submitted this for compliance review on January 20th. And this has changed a little bit since then, but not a lot. But you can see as you scan across that we have exited a great deal of the commodity complex. So commodities themselves, natural resources, the energy companies and so forth. We're still long in some of the energy infrastructure, as we still see a play there, especially in the midstream companies that are transporting energy. And then you see the others there. And again, the fixed income sleeve on the right was pretty much empty at this time. We've since re-entered our high yield position. And of course, our muni sleeve is doing quite well, which is 72% invested today. So over 2014, which sectors did the best is important to note, and it was utilities, which surprised a lot of people. Utilities ended up having returns that are not common for utilities. Consumer staples and REITs. And also on the fixed income side, the munis did far better than corporate bonds. So that covers where we've been as far as how we handled our models in 2014, and basically this one here. I'm going to move on and start to talk about the macroeconomic environment and where we are today. So I'm going to speed it up a little bit. The state of the U.S. economy, we're starting to see some pretty good growth. Still, we're not at the growth level of previous recoveries by far, especially on the employment side of things. The unemployment rate has been ticking down. Good news. We still get concerned about labor force participation, and if you have been on this before, we believe in the labor force participation rate much greater than we do on the unemployment. There's way too much noise in that unemployment number. We're still concerned here as we put this line in that takes you back to where we are historically from today. It goes all the way back to about 1976. So we're looking at a period of time of almost 40 years that we haven't seen such a low labor participation rate. These are meant to be people who are ready, willing, and able to work, but for some reason they're either not in a job they want or it's part-time. That's still a concern of ours. We don't think that we're going to see significant improvement in wages, although the last quarter did show a nice uptick in wages. We don't think we're going to see a significant growth in wages until we see that labor force participation rate improve. That's a pure supply and demand dynamic, and hopefully we start to see some improvement there. Home prices, there we go, sorry. Home prices have done well. Home ownership rates have fallen a lot. A lot of the 30-somethings are choosing to rent nowadays. Home prices here in the Bay Area, as most of you know, have just been phenomenal. We're not seeing a lot of supply. Evidently, there's more supply coming on. Next quarter, I think we'll have Mark Machado, our real estate expert, outside expert, join us to talk about the real estate market. The deficit has been down and debt has stabilized, pretty much forced upon, and the positive result of the president and Congress not getting along very well. So sometimes that could be a good thing. We do see that the Federal Reserve balance sheet is over $4 trillion, absolutely unprecedented in our economy. And the Fed's intentions of how they're going to get out of it, Janet Yellen just plans to let things expire off of the balance sheet. That will take years and years for that to happen. We believe here this has been a big experiment. They don't know how they're going to get out of this and how the balance sheet is going to come back down. So time will tell. We will see. Monetary policy, you know, what's good for the goose is good for the gander. The rest of the world seems to be taking on the aggressive, as Andy talked about earlier, the unconventional actions of the Federal Reserve. Japan doing unprecedented quantitative easing. The European Central Bank here at the time, it said it was promising QE. It has since announced a $1 trillion QE policy. The Bank of China has reduced capital requirements, lowered rates, and is really doing a lot to try and stimulate their economy so that they can grow and try and get themselves back to what was normally 10–11% growth for China. Many people don't think we're going to see that again. It's going to be more like 6% growth. China is going to have to do something because the burgeoning middle class in China expects there to be more like 7 to 10% growth. We've all benefited from the great increase in supply of oil, which has lowered the price. There's been just a glut of oil in the world. Some people are benefiting, some people are not. You can see here, United States is now producing more oil than anyone. What a surprise. We would have never expected this 5–6 years ago, but here it is. And you can tell when you go to the gas station to fill up. For those of you that own SUVs, and that's a lot of us, I know for me, when I go to the gas station, it's costing almost half for me to fill up than what it did, you know, a year or two ago. So that's very beneficial to the macroeconomic environment so that consumers can do more consuming, which is about 70% of the economy. However, this morning I saw a report where that's not really coming through yet. And the concern there is that the increase in healthcare costs are compensating or overshadowing that benefit that people are getting from the lower energy prices. So I think we still have some more quarters to see what's really going to happen here. Again, consuming countries will benefit more. China is buying oil and stockpiling oil. They are buying way more oil than they are using in order to take advantage of this situation. There are some losers out there that are completely dependent on oil prices being very high. You can see Venezuela needs it to be $120. Then there's other countries out there that completely depend on it. Iran's economy is just not doing well at all because of this. You can see that statistic there. Last year, they spent 25% of their GDP on consumer spend subsidies to try and boost their economy and placate their people, and Russia. So our concern is, out of all of that, if we go back one, our concern out of all of that is that when bad actors start to have trouble with their economies, they tend to act out. And so our concern are some of these bad actors that have been completely reliant on oil prices being over $100, they're going to start to act out. That's where we get these asymmetric geopolitical events that none of us are expecting, that prognosticators don't include in their prognostication, and then that's when we get surprises of things that happen in our markets. With that, I'll turn it back to Andy.
Thanks, Bruce. So we are not, as Bruce said, in the business of prognosticating, but we do actually report some of the analysts and opinions of others in taking a look at where we may be going. So let's start by taking a look at where we may be going with taking a look at global GDP. This chart basically tells us that global GDP should be about 3.4% in 2015. It's not great, it's not horrible, this is just what this prediction is. The thing to note, though, however, is that the United States leads the developed nations with a potential 2.6% prognosticated GDP. But like Bob Dylan says, you don't need a weatherman to say which way the wind blows.
Well, this is, there's an old joke: is why are there weather people?
Why are there weather people, Bruce?
Right, yeah, there's a setup. Why are there weather people? So there's weather people in order to make economists feel good about what economists do, right? And it just shows, right?
So this next slide outlines, the next few slides actually, are going to outline what could affect GDP growth in the United States. What kind of storms might be on the horizon? The biggest one is a negative global event. There's also the potential of deflation derailing the economic recovery in Europe. What else could happen? Potentially policy mistakes, commodity prices continuing to slump and hurting emerging markets. As Bruce talked about before, the potential geopolitical unpredictability of the powers that be in places like Russia and Venezuela and Iran. I mean, have you ever tried to corner a cat? Right. But oil prices staying low could have a potential boost to the global economy as well. So there's the flip side of what could happen. I mean, there's an entire budding, emerging market middle class over the next 10 years that could represent 30% of the globe's consumption. And lower energy prices could fuel that, no pun intended. Here we are again talking about Russia. I mean, their intervention in the Ukraine. I mean, this could escalate. It could lead to more Cold War type tensions. And it could have, as one of my favorite words is in this quote, and I will quote it, it could have deleterious impact on the Euro region's economic recovery.
Who talks like that?
The Economist.
It's amazing.
It's a great word. 5 syllables. Another factor, which Bruce started to talk about before, is how sustainable is China's GDP really? And a slowdown in China, what could that be? I mean, we have some statistics that basically told us that if the slowdown in GDP in China was at 2%, it could affect the U.S. GDP by a quarter of a point or 25 basis points. So when China sneezes, we could very easily get the sniffles here in the United States. Also, we've got bickering politicians who have some very, very significant challenges with the new Congress this year. We also have a potential Fed rate hike, which everyone is waiting for with bated breath and fear and trepidation.
Yeah,
when is this going to happen? So where does this lead us? The best case scenario is that these things do not affect American economic growth. The worst case is growth falters. We believe that it's probably going to be a little bit of both. And the great experiment lives on.
And we need to watch out for this political bickering between Congress and the White House. There are things that have to happen here coming up shortly. Spending bills, continuing resolution bills, these things are coming. And every time that this happens and we get close to, are we going to have a government shutdown? Are we going to have these sorts of things? It spooks the markets. It creates all these problems. These things are coming. So in the next 1-2 quarters, there's some significant things that need to get settled here. So hopefully they get along.
Yeah. Good. Yeah, government shutdown is very funny because it does create this frenzy and craziness in the news. I remember last time, 78% of the government functioned normally.
Right.
But I had to go to the building department to get a permit, and they're closed that day because of shutdowns. So as we're talking about where this GDP could be coming from, this pie chart addresses actually that, where it could be coming from. And so there are really 4 main areas here. The first, of course, is more consumer spending, as outlined in blue. The second is a continually improving housing market. The third is the continued and lower oil and commodity prices. And my favorite, of course, is the other.
Yeah, too many others.
I like the other, because in this case, it could represent things like whether the American League or the National League wins the World Series next year.
But seriously, the big pie here, the big piece of the pie is consumer spending. Right. So if we don't have good consumer confidence, if people aren't using this money, they're saving at the gas tank, we need to see that. And unfortunately, the holiday season didn't prove to be as good as everyone thought and expected. So hopefully it comes through.
Right. And the great paradox, the economy needs people to spend, and society needs people to save, so they can be self-sufficient at the same time. These next few slides illustrate the difference of opinions of some of these prognosticators as it relates to just market predictions. So Barron's Outlook went out and polled 10 market strategists, and the consensus was the U.S. bull market will continue. So where are we going with these stock prices? What this slide is basically, so interesting enough, we can see that while some earnings growth is expected next year, stocks are not cheap. The PE ratio in this chart as of December 19th is at 15.8 future earnings, but the key to it is that it's slightly above both the 5- and 10-year averages. And what this really means is that earnings need to be positive and to meet and beat expectations in order to maintain and sustain these PEs. Otherwise, there's going to be a market correction.
It's even higher than this now.
Right. Yeah. Global business leaders, we have waning optimism. What this slide shows us in the right-hand column under the heading of balance here is that global business leaders believe that less global business leaders believe that the situation is going to improve for business conditions. They think it's going to worsen. That's what this particular slide is telling us. Optimism varies by industry. As you can see, the builders are optimistic. Techno-tweeps are optimistic. Service providers are optimistic. Manufacturers may not be. This quote from Barron's in December talks to the investment opportunities that might be available in Europe compared to those that are in the United States, while simultaneously talking about the risk of deflation in Europe, which could affect the entire probability of the European economy, profitability of the European economy. So again, we have people speaking from both sides. No one really knows. Time will tell, but we're paying attention to what these different people say and the indicators that might be behind it. The point is, though, I think that no matter what happens in the world in 2015, there will be opportunities for investors. And as you've seen before with us, and cause for pause. There may be these may be in particular sectors or industries or regions. And knowing this is why we developed our ETF global sector strategy that Bruce was talking about before, so that we can take advantage of those particular sector or regional opportunities. As you've heard us say numerous times, owning any security has an inherent risk. If we understand the risk and we like the risk, we're going to buy the security. If we don't think we understand the risk and we don't like the risk, we're not going to buy that security, and temporarily that money can sit in cash till we find another opportunity we like. So we've spent a bunch of time here discussing the outlook for world economies and markets, but really it's just as important for us to know what's going on in your lives. Things may be changing. Maybe somebody's getting married. Maybe there's a new grandchild. Unfortunately, maybe an illness cast a shadow on your household. No matter what's happening in terms of life cycle events, it's important to know that we can help determine whatever the appropriate financial strategy is that's right for you, given those circumstances. Whoops, where am I? Sorry, I'm getting there. Yep, thanks, Sally. So no matter what happens in 2015, we're here to help you. And as Bruce talked about before, our disciplined investment process is designed to help you reach your financial goals. We continue to monitor, I can't speak today, economic and market developments closely. We don't let the noise and the chatter of day-to-day events determine our actions. We will not take action until our process indicates that we should. We have great confidence in our process, and that's the reason that we sleep well at night, and hope you will too. Before I turn the presentation back to Bruce, I do have an exciting announcement for you. As you know, Yerba Buena Financial Partners was founded on the principle of being independent and conflict-free. And Bruce and I have done that for over the last 10 years and maintained a practice that way. In our continuing evolution, it's really exciting for us because we're going to be re-registering our firm with the appropriate regulatory authorities to be our own RIA, or Registered Investment Advisory Firm. What does this mean to you? This is going to allow us greater flexibility and more timely communication and more transparency about our models that Bruce spoke about before, that compliance kind of holds back on some of that, and our investment strategies, so that we can just communicate more clearly and more timely about what's happening. This is very exciting. We're beginning this transition now. It should be completed in the spring of this year. For those of you who are advisory clients who have either the SAM, Strategic Asset Management accounts, or OMP, Optimum Market Portfolio accounts, you should expect a mailing from us over the next 60 or 90 days, which basically will explain what we just said and have a simple one-page form, a little bit of paperwork we need to do. We are really excited about what this is going to allow us to do for you. Thanks again for your time, and at this point I'd like to turn the meeting back over to Bruce.
Thanks, Andy. So while we're making announcements, I want to let you know that we have formed an outside team of expert advisors here at the firm. Our outside team of expert advisors enables us to provide advice and get input from a whole realm of other professionals in related fields. So, of course, Michelle's here today representing accounting. We also have people on the team representing law, right now estate planning, most especially, and lending, and real estate. We'll be adding some other specialties in the future, but the idea here is for us to be able to seek out this team when we have things come up in our clients' lives and in their affairs where we need to reach out to trusted other advisors that we know we can rely on. So we're very excited, and thanks, Michele, for being part of it. And with that, let me introduce Michele. Michelle's the managing partner of Eckhoff and Company and is responsible for ensuring that firms continuously striving to bring innovative solutions to their clients and train and develop their staff and future leaders to earn the reputation of CPA and the firm of choice in the community. We've been working with Michele and Eckhoff for 10 years now in helping mutual clients. It's been a wonderful experience, and our clients really benefit from that. Michele looks like she's 30, but she has over 30 years of experience in accounting and auditing in a variety of industries. She's actually the managing partner over there at Eckhoff and Company, and she assists clients with their financial and operational needs by developing solutions to problems by integrating knowledge from personal experience and as an entrepreneur herself. Michele and her husband Rudy have owned many businesses over the years. So that's some great expertise to utilize in helping clients, and the resources they have over at Eckhoff is just wonderful. Michele enjoys entertaining friends and family, gardening, volunteering at various nonprofits, and I have left for last, cooking. Michele is a great cook. I've experienced it at several parties at your house, and when's the next one, Michele?
We'll have one too.
So with that, we're going to turn it over to Michele here for a little bit to talk about what the heck is going on in the tax world. It's great timing. We're in the middle of tax season. So please, Michele, tell us what are the hot topics? Yeah.
Hot topics. Well, thank you, Bruce. Pleasure to be here. Today we're going to review just 4 of the top tax developments that will affect many taxpayers and impact 2015 and beyond. Of course, there were other tax developments in 2014 that may be more significant to any particular taxpayer depending on the circumstances, so it's important that you consult a tax professional to review your unique tax situation. The first of the 4 that we will discuss is the passage of the extenders package. There was passage of an extenders package, but Congress failed to pass its usual 2-year extenders package and instead settled on a 1-year retroactive extension to January 1st, 2014. So it's been left to the 114th Congress to debate the extension of these tax breaks in 2015 and beyond, and for taxpayers to guess what expenses in 2015 will again be entitled to a tax break. Some of the federal tax breaks that were extended include the tax-free distributions from IRAs for charitable purposes, if you're over 70.5 years of age, and the increased expensing allowance for business assets, computer software, and qualified real property such as leasehold improvements or restaurant and retail improvement property, also known as bonus depreciation. Next are the repair regs. In 2014, after a decade of deliberation, the IRS issued final regulations regarding the accounting for materials and supplies and the capitalization of tangible assets. These are the so-called repair regs, which impact most businesses. 2014 is your last opportunity to get it right. That means depreciation schedules need to be scrubbed clean. Assets that no longer fit the definition of cost that should be capitalized need to be removed, and vice versa. Expenditures considered repairs or otherwise expensed in prior years may need to be capitalized and added to your depreciation schedule in order to comply with the new definitions. The bottom line is the regs changed the traditional way of thinking about which tangible assets, equipment, building improvements, etc., need to be capitalized, and that's just one of the provisions of this new law. The repair regs are lengthy and complex and could mean big dollars that will affect your taxable income for 2014. Also note that the state of California has not adopted any of the new federal regulations, making income tax preparation even more cumbersome. Third is the net investment income tax. Many higher income individuals were surprised to learn the full impact of the net investment income tax on their overall tax liability last year during the 2014 filing season when their 2013 returns were filed. Starting in 2013, taxpayers with qualifying income have been liable for the 3.8% net investment income tax. The threshold amounts for that tax are $250,000 in the case of joint returns or a surviving spouse, $125,000 in the case of a married taxpayer filing a separate return, and $200,000 in any other case. Recent run-ups in the financial markets and the fact that the net investment income thresholds are not adjusted for inflation have increased the need to implement strategies that can avoid or minimize that tax. Last, retirement planning. There were 5 notable changes made during 2014 affecting IRAs and other qualified plans. Distributions from a 401k, 403b, or 457b account may now have the taxable and non-taxable portions of the distribution directed to separate accounts. Also, IRA holders and defined contribution plan participants are now permitted to obtain the so-called longevity annuities to help ensure that they will not outlive their required minimum distributions. 401k plans are now permitted to offer deferred annuities through target date funds, also known as TDFs. The IRA rollover rules were reinterpreted to state that a taxpayer is limited to one 60-day rollover per year for all IRA accounts under the tax code rather than one 60-day rollover per year for each IRA account. The new interpretation of the rollover rules is applied to rollover distributions received on or after January 1st of this year, 2015. And last, a 2014 Supreme Court decision, Clark versus Ramaker, found that inherited IRA accounts were not retirement assets and therefore not subject to creditor protection under the bankruptcy code.
That's a raw deal.
It is. So in looking forward, although 2014 was clearly not the year for major tax reform, experts do expect that Congress will complete some form of tax reform this year or 2016. So stay tuned.
Thanks, Michelle. So, question for you. So, as you guys talk over there at the firm, I think you have, what, 4 or 5 partners, right? Yes. And this tax reform issue comes up all the time, right? And we never really see it. And they talk about, you know, some people talk about very serious tax reform, like a flat tax or a fair tax, which I don't know that we'll ever see. But as you're out and you're attending your conferences and continuing education and whatnot, what is the tax world saying about the reality of us and ever having any meaningful tax reform? And I have to say, we didn't plan this, so
yeah, no, that's okay.
Just throwing this at you.
I would say it's mixed. I think most people don't believe that there'll be anything major, at least in the near future. What most people do say, though, is they believe rates will go up, and
tax rates
will go up, and that's what we can expect. As far as major tax reform, you know, overhauling the tax code in any way, it's just getting more and more complicated. Yeah. It really is. It's not getting simpler.
So every lobby has their hot issue, and they're the ones who make the political contributions. So to get anybody to agree to it is...
It's impossible. I mean, the new repair regs that, you know, were finalized took 10 years.
Oh my goodness.
And they're so complicated. Almost every taxpayer can expect that there's going to be more time to prepare their return for themselves, the work that they're going to have to do, and the work that their tax practitioner is going to have to do.
Which means that just the prep fees are going to be higher and higher. And then when we talk about increasing tax rates, and we're talking about the nominal tax rates that people pay, so everyone always thinks about the tax rates for the wealthy, right, the 1%ers. That's not going to pay for the obligations of the government, so there's a lot of hidden taxes in the tax code, and as we run around and spend money all the time. What is the talk about the increase in tax rates on, you know, normal folks who aren't making $1 million a year?
Well, I don't know that there's a lot of talk now about that. At least I haven't heard anything recently about the normal, right? Right. The everyday middle-class American. Okay. I'm hoping those stay steady.
Okay.
Are they trying?
Go ahead.
Are they trying to soften the blow, Michelle? I was out the other day and I was consuming, and the software that printed out the receipt, of course, had the sales tax line item, but then it had a line on it had VAT, the value-added tax line item, which is something we know for friends north of the border.
That's right.
And other places, and it was zero.
Okay.
It was
Are you
good.
serious?
Yeah.
So like they're trying to prep your head for that.
That's interesting.
Has there been discussion about a VAT, a value-added tax across the board?
This country will do
Oh
that.
my goodness.
Yeah,
I haven't heard anything, honestly.
And to do that in combination with the taxes we already pay.
I can't imagine.
There's talk now that because the gas prices have gone down so much that there's a lot of politicians, because the government's not getting near the amount of tax money they were getting. So now they're whining and want to raise the gas tax in order, because the highway fund trust fund is really down to the brink right now. And they're talking about what are we going to do about that, because it's going to run out. Last question. How much are you seeing people come in and with their creative self-tax or deciding what they think is deductible, especially small business owners? Because you know what, an issue near and dear to my heart.
They can be very creative.
Mm-hmm.
So it is, you know, there's so much information out there now. Everybody has the internet, and there's talking always amongst business owners. I took this and I took that deduction. So many times it really is inaccurate, and we have to guide them in the right direction. And
not allowed. Do you have any funny ones that come to the top of your head?
Oh, goodness.
Or just outrageous ones? Next time I'll ask you.
I will have one ready next time.
All right. Sally?
Great. Thank you, Michelle, Andy, and Bruce, and to all who attended YBFP's first quarter forecast webinar. Please look for information about our second quarter webinar targeted for May. This concludes our presentation. We do have a couple of minutes to open the lines for some questions, but if we do want to close the presentation right at 1 o'clock. So we will also allow you guys to send email for questions, and advisors will give you a call right back. So we'll open the lines now, and you can let us know if you have questions. Just one moment. You've all been unmuted if you'd like to answer a question or ask us a question.
Can I ask them questions?
Yes, you can.
Does anyone have a question?
No, thank you.
That means we did such a wonderful job. Right?
Any favorite topic?
Let me just say that we have changed the technology that we're using for this, and it won't allow us to do a survey, and we're trying to work on that. But if you have any feedback, suggestions, ideas, we have some ideas here, then I think we're going to change it up a little bit next quarter. Please feel free to email Sally your ideas, even criticisms, we don't mind. Because we want to continue to improve this. We're back to doing these every quarter. We took a bit of a hiatus there. But now that we have Sally on board, we're able to do more of these kinds of things. So we would love your feedback.
Great. Thanks, Bruce. Well, thank you, everyone, for attending. We hope you have a great day.
Thank you, guys.
Bye. Bye.
Ciao.